Hey guys, this is Ben here, ex-pilot, hedge fund manager, and now a multi-asset trader across most timeframes, plus obviously senior ITPM mentor. So I hope you all been doing well, trading some exciting names, making some money. My mentees certainly have some clock and returns over 50% year to date so far, so not too shabby. So the focus has been on semiconductors and tech, and also more recently crypto this year. It's been all the focus. There's been other areas, that are starting to look more interesting now that have kind of made moves a little bit under the radar, specifically metals. And I'm going to talk to you guys about that a little bit today and see what's been going on. So I'll start this off with a look at gold futures, with a commitment of traders report for large speculators at the bottom. And gold has been in this kind of multi-year range. So large speculative interest hasn't really been very exciting. It's just kind of been hovering kind of sideways. But year to date, gold is up a little over 5%, and it's actually close to 10% upside from the 2000 support level that was recently reached. Now, it's not really a huge surprise to see the net positioning for large speculators gaining some steam. But we kind of need to see that figure really breaking out above 210,000 net contracts long to confirm a multi-year breakout potentially, which could have some legs, which we'll see. But the question here is, why is this happening? All right, so gold is actually really thought about as an inflation hedge, by most people, really. But it's not actually true. So gold is inversely correlated to the US dollar. And that's because gold is priced in dollars. So a weaker greenback attracts more foreign buying, and it tends to kind of put a bid under gold. So what does the dollar tend to do when inflation is strong? Yes, it rallies. So gold actually has more of an inverse relationship with inflation, at least in the short term. And that's what we're interested in in our time frame. And you can see that pretty clearly on this 10-year chart of the US inflation rate versus gold prices. Now, there's also the geopolitical tension, which is not really getting any better, especially in Europe, with Russia just kind of doubling down, and it does not look like that's going to end anytime soon. So when there's major or potential for major geopolitical problems, or just kind of anything that's pretty radical that can happen, people run to buy gold. It's kind of a safe haven. Even with the rally in Bitcoin we've seen recently, people's appetite for gold has actually still been strong. But there's also something else that's going on that's going to contribute to this move. There are pretty lofty valuations right now in the S&P 500 and other areas of the market. Many large cap stocks trading at record highs, which isn't a bad thing in itself, but the valuations are up there, and it really starting to show signs of institutional distribution. And that typically leads to not really money leaving the market. It's kind of a rotation going on. So money rotates out of highly valued assets and into other areas of the market. So the forward PE right now for the S&P is around 20 or so, a little bit above, I think. But the average is closer to 15 or 16. So investors are looking for better value. It doesn't mean the market is ready to crash anytime soon. We're seeing a little bit of trouble, I guess, especially today. But it's more kind of just sideways action, with any type of rally tends to get sold off. And that's because there is now rotation into other assets like gold, just more attractive valuations. So we're going to have a look at some examples and see what's going on. Now, the first stock that comes to mind is Newmont Mining. It's the biggest gold mining company in the world, actually. And they're also involved in other metals such as copper and silver, etc. So here's the thing though, price moves in precious metals, especially gold, feeds straight into their bottom line. So what's been going on with kind of top line basic fundamentals in Newmont? So besides relative low valuations and a dividend yield of 4.3%, the earnings estimates here is kind of an interesting story. Okay, so the company report earnings towards end of April. Estimates are for 37 cents. During the last quarter, they reported 50 cents, beating by 6 cents, and EPS same quarter last year was 40 cents. So with this massive rally in gold, it's kind of hard to see the EPS falling versus what they were last quarter or the quarter last year. Okay, it doesn't really make sense. So I think we're kind of getting geared up for a large upside surprise when earnings comes out. So if that's the view, I can structure a diagonal option spread and mill credits for April while long May, okay, and position myself for earnings beat. And that's just one example of how to play this. Now, there's obviously a lot of other ways to benefit from the potential move, basic ETFs, GDX, and so forth. So I cannot go on and on about gold, right? But let's talk about copper, because copper is actually a little bit more interesting. Now, copper is an industrial metal used for infrastructure applications such as electronics, equipment manufacturing, building, construction, transportation, and other industrial fields. So with the US economy holding firm and mortgage rates have been falling actually quite hard, there's a pretty good chance that the housing market will improve and start picking up some steam. And guess what? They need copper, among other materials. So here's a look at housing starts versus copper prices. And you can see it's a pretty strong correlation. So the push towards anything EV is another thing going on. Okay, so when you start pushing everything into EV, well, you need copper for electronic applications. Is the prime, really prime material going on. So there's a lot of other stuff happening under the hood. I thought that's a kind of a deeper topic for a different day. But as long as copper can hold about $4 a pound, there are a lot of opportunities that start to look interesting. And these are just some simple examples of how we can benefit from what's going on in these various markets. Now, as traders, we need to put on our Sherlock Holmes hat, okay, and look for clues and developments. But obviously, that implies that you know what to look for. So that's a wrap. Till next time, over and out.